Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at NextNRG.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and a quick note before we get into today's stock. If you trade stocks, crypto, forex, gold, or indices, and want clear buy and sell signals, you can check out VIP indicators through my link below. Grow $100 to $10K with VIP indicators.
Which is an amazing tool to have in your arsenal.
Oh, absolutely. VIP Indicators offers TradingView indicators, market alerts, trading education, and chart reading support with up to a 93% win rate. The tools are designed to help traders spot possible setups faster and trade with more confidence.
But, we always have to remind everyone, trading is risky.
Yes, very risky. No indicator can guarantee profits, and growing $100 into 10K is not guaranteed. Use these tools for education and analysis only, manage your risk carefully, do your own research, and never trade money you cannot afford to lose.
Exactly. Safety first, always.
Right. And just so you know, this is an affiliate link, so I may earn a commission if you use it, at no extra cost to you.
All right, so let's get into the hook for today. I want you to picture a scenario that just, it totally defies basic business logic.
It really does.
Right. Imagine a technology firm holding a suite of exclusive, completely futuristic patents, and they're operating in energy infrastructure, which is arguably like the most heavily funded sector on the planet right now.
Oh, without a doubt. The money pouring in is staggering.
Exactly. And they aren't just surviving, they're posting a massive 56% year-over-year revenue growth. So you would naturally assume their bank accounts are just overflowing with cash.
You'd think so, yeah.
But what if I told you this exact company, navigating millions in monthly revenue, currently has less cash in the bank than the price of a modest suburban home?
It's the ultimate corporate paradox. It perfectly illustrates what venture capitalists call the valley of death.
The valley of death. That sounds intense.
Well, it is. You have a balance sheet that is screaming imminent crisis, but it's paired with an income statement that's flashing undeniable hypergrowth. It's a fascinating puzzle we're trying to solve today.
All right, let's move into the wealth building context.
Right.
Because you really can't appreciate the stakes here without understanding what NextNRG actually built and why it matters for creating long-term wealth.
Right, the technological moat. That's the core of their value proposition.
Yeah. Their entire moat relies on 7 exclusive patent licenses that came out of Florida International University. And these filings cover some wild stuff like smart microgrid architecture, virtual power plant coordination, and even wireless EV charge transfers.
And out of all of that, the virtual power plant aspect, or VPP, that's the absolute linchpin.
Why is that? I mean, a virtual power plant sounds like sci-fi to a lot of people.
Well, the transition to electric vehicles, it isn't just about manufacturing more cars and plugging them into a wall. The power draw required for massive commercial fleets is just immense. The legacy grid simply cannot handle it.
It would just melt down, basically.
Exactly. So a VPP solves this by aggregating all these distributed energy resources. Think about a delivery company with, say, hundreds of electric vans.
Okay, so they plug them all in at night.
Right. When those vans are plugged in, a VPP software layer treats those collective batteries as one giant energy reservoir. So if the local grid is under heavy strain, the software can just temporarily halt charging or, get this, even sell power back to the grid from the vans.
Oh, wow. So they become a mini power station.
Exactly. And when grid demand drops and power is cheap again, it just resumes charging. NextNRG isn't just building the physical charging station, they're providing the AI brain that coordinates that whole localized energy market.
To put a visual on this for you, their core platform is called the Next Utility Operating System. If you look at a commercial fleet operator today, their energy logistics look like a living room table covered in like 6 different completely incompatible remote controls.
It's a total mess.
Yeah, they have one system tracking diesel deliveries, another app for the EV stations, a separate dashboard for the warehouse solar panels, and another just for routing the trucks. NextNRG comes in and replaces all of that with a single AI-driven universal remote.
But it acts more like a smart thermostat for the whole fleet than just a simple remote control. It doesn't just consolidate the buttons, it actively learns and redistributes resources on the fly.
So it's making decisions without a human having to click anything.
Exactly. The AI recognizes, for example, that truck A has a shorter delivery route today, right? So it automatically redirects the excess overnight battery charge over to truck B, which is scheduled for a heavy-duty cross-country run.
And the moment a fleet operator installs that kind of automated air traffic controller, I mean, they can't imagine running their logistics blind ever again.
And that is where the wealth-building magic happens. The switching costs become astronomically high. Ripping out a software ecosystem that has already learned your routes, optimized your fuel spending, and integrated everything, it's an operational nightmare to leave.
So once they're in for good.
Exactly. The deeper NextNRG embeds its AI into a customer's daily workflow, the wider their competitive moat becomes.
Now let's look at the fundamentals. Because building a moat like that takes serious capital. And when we look at the financials, the math of how they pay for it completely breaks down. Let's start with the top line, because the revenue metrics are shocking.
The growth is just explosive. In the first quarter of 2026, top-line revenue jumped 29% year over year, hitting $21.1 million.
Which is huge.
Yeah, it completely shattered the analyst consensus estimates. Those were sitting around 18.1 million, I think.
And the preliminary April numbers just dropped, too. They reported a record $9.4 million for that single month. That is a 56% surge compared to April of the previous year.
But what stands out even more to me is the underlying efficiency. It isn't just revenue growth fueled by, reckless marketing spend. Their gross profit actually more than tripled in Q1 to $1.7 million. They managed to expand their gross margins from a razor-thin 3.2% all the way up to 8.1%.
And expanding margins while scaling that fast, I mean, that is notoriously difficult. How are they pulling that off?
It's all about transitioning from a fixed-cost legacy delivery model to a high-margin, software-optimized model. That margin expansion is the direct result of the AI route optimization we were just talking about.
Because the software is dynamically routing their mobile fueling trucks, right? So it's reducing idle time and fuel waste.
Exactly. They are capturing more profit per delivery trip simply because the algorithm is making the physical truck smarter. Plus, they managed to slash their interest expenses by 80%, bringing it down to roughly $680,000 for the quarter.
Okay, but wait. If they are pulling in over $9 million a month in revenue and tripling their gross profit and slashing interest expenses, why does the balance sheet look like a crime scene?
Yeah, that's the big elephant in the room.
As of March 31st, NextNRG held exactly $208,048 in cash and equivalents. 200 grand. And their trailing 12-month net income is negative $86.41 million.
This is the brutal reality of scaling heavy infrastructure, unfortunately.
But $208,000, I mean, a single month of corporate payroll has to wipe that out entirely.
Oh, it absolutely does. The discrepancy comes down to the CapEx cycle, the capital expenditures. When you are deploying microgrids and physical fueling fleets, the costs are incredibly front-loaded.
Because you have to buy all the physical equipment first.
Right. You buy the equipment, secure the permits, pay the engineers, build out the tech stack, all long before a client pays their first monthly invoice. That negative $86 million net income is basically the ghost of all that upfront heavy lifting.
So how are the lights still on? Management has to be running an absolute masterclass in corporate survival tactics.
They really are. They're actively diffusing the balance sheet through liability reduction. Your most critical move happened recently when they executed a massive debt-for-equity swap.
Let me break down the mechanics of that swap for you. Basically, a creditor who was owed actual cash agrees to tear up the IOU, and they take shares of NextNRG stock instead.
And the psychology behind that decision is profound, honestly. Think about the leverage a creditor has there. If you're owed millions by a company that only has 200 grand in the bank, you hold all the cards.
Yeah, you could just force them into bankruptcy restructuring, liquidate the assets, and take whatever pennies on the dollar you can get. Take the guaranteed cash and run.
Exactly. The fact that these creditors accepted paper stock over cash, that implies they genuinely believe the long-term equity value will vastly exceed the cash they are owed today. It is a massive signal that institutional partners are betting heavily on that 56% revenue growth.
That brings us to the catalyst timeline, because that underlying conviction from insiders is fascinating. But what is actually going to drive this forward for new investors?
The Neutron-X partnership is the single most important variable here. It's the ultimate catalyst.
Right, NextNRG secured an exclusive 2-year partnership with Neutron-X. And the big news is that NextNRG just obtained its CAGE code. For those who don't know, what exactly is a CAGE code?
It stands for Commercial and Government Entity Code. It's essentially the administrative golden ticket you need to officially bid on and actually receive contracts from the U.S. federal government and the Department of Defense.
And they aren't going after small, local municipal projects either. This partnership is actively chasing a pipeline of federal energy infrastructure and security contracts estimated between $1.3 billion and $2.2 billion.
Which is astronomical. And the macro environment is practically begging for the exact technology NextNRG provides.
Between the federal infrastructure investment funds and the Inflation Reduction Act, the government has earmarked billions specifically to accelerate fleet electrification.
Exactly. And to harden the energy grid against cyber threats, build distributed microgrids, all of it. A cage-coded partnership offering AI-managed VPPs is perfectly positioned to capture that capital.
Now let's pivot to the chart. Because all of this fundamental tension is causing absolute schizophrenia on the stock chart right now. Following the Q1 earnings beat, the price action became incredibly violent.
Oh, it exploded. Shares surged over 91% in the pre-market, hitting 53 cents.
And breaking that 50-cent threshold is a massive psychological and technical resistance point for microcap stocks.
Yeah.
It signals a shift from a stock that's, left for dead to one that is actively being accumulated.
If you look at the technicals, the stock is now trading about 53% above its 20-day simple moving average, and it's 35% above its 50-day moving average.
But it is still sitting nearly 55% below its 200-day moving average. So what does that divergence actually tell us about the turnaround narrative?
It maps out the anatomy of a dead cat bounce versus a genuine reversal. Trading heavily above the short-term averages shows that aggressive new buying pressure flooded in, right? They reacted to the revenue data.
But the fact that it remains so far below the 200-day illustrates the immense technical damage inflicted over the past year.
Right. Anyone who bought the stock 6 months ago is still trapped underwater, and they are eager to sell just to break even. That 50-cent pivot is the exact battleground where the market decides if the turnaround is real.
And there is a major warning sign flashing in the momentum indicators, specifically the MACD. Even with a 91% price spike, the MACD indicator remains below its signal line and the histogram is negative.
The MACD is crucial here because it measures momentum by tracking the gap between a short-term trend and a long-term trend, usually the 12-day and 26-day exponential moving averages.
So if the price is up 90%, why hasn't the MACD crossed over? Shouldn't the technicals be glowing bright green?
Because price spikes can be very deceiving. A sudden gap up in pre-market trading often happens on low liquidity or short covering. The MACD requires sustained, compounding price action over several days to pull that short-term average high enough.
Got it. So the negative histogram tells us that the underlying momentum hasn't validated the sudden price jump yet.
Exactly. Unless heavy, consistent buying volume steps in, that massive pop could easily fade right back down.
So what does market sentiment look like? This technical tug-of-war is perfectly mirrored by the analysts covering the stock. The broader consensus is aggressively bearish. We're looking at 15 sell ratings compared to only 2 buy ratings.
Conservative institutional analysts are strictly bound by their risk models. When a company's cash drops to $200,000 against an $86 million trailing net loss, those models automatically trigger going concern warnings.
They simply cannot recommend the stock, regardless of how good the technology is.
Right, but then you have H.C. Wainwright stepping in and initiating coverage with a price target of $5.
Which is wild. With the stock hovering around 50 cents, that implies an almost 1,000% upside.
It's the ultimate reflection of the valley of death. The bears are strictly pricing in the balance sheet, assuming imminent restructuring. The bulls are pricing in the 56% growth rate and the AI moat.
Assuming they survive the liquidity gap.
Exactly.
Now let's talk about the risks, because I have to push back hard on the timeline here. Government contracts are notorious for administrative quicksand. The bidding process takes months, the awarding process takes months, the payout takes even longer.
It's a very slow process.
NextNRG has $200,000. They do not have 18 months to wait for a federal check. How do they survive the wait?
You've zeroed in on the absolute most critical risk facing shareholders right now. Even if NextNRG announces a massive $500 million federal contract tomorrow, NextNRG doesn't get a wire transfer the next day.
Right. The gap between winning a bid and realizing the revenue requires operating capital. Capital they simply do not possess.
which means imminent capital raises are a near certainty. If they cannot secure non-dilutive funding, like a grant or a buyout, they will be forced to rely on APM or at-the-market offerings.
And an ATM offering aggressively punishes current investors. For those who aren't familiar, in an ATM program, management slowly issues and sells newly created shares directly into the open market.
Right, during normal trading hours. So whenever the stock price spikes on good news, the company sells shares into that buying pressure to raise cash.
It heavily dilutes the existing shareholder base. Your slice of the company's future earnings gets progressively smaller. And that constant selling pressure artificially caps the stock price, keeping it from breaking out.
They essentially have to dilute their investors just to keep the lights on long enough to see the contract money.
Management is trying to thread an impossibly tight needle here. They have to sustain 56% revenue growth, land a federal contract via Neutron X, and somehow source bridge capital without completely vaporizing the equity of the people holding the stock right now.
They've shown they can access capital creatively, like with the debt for equity swap, but the clock is definitely ticking louder every single day.
So with everything on the table, what's the final verdict? Synthesizing the incredible technology, the hyper-growth, and the terrifying balance sheet.
The research assigns NextNRG a bullish score of 6 out of 10.
A 6 out of 10. That perfectly captures the underlying anxiety of this setup, honestly.
It really does. It is the definition of a speculative asymmetric play. The long-term view is that you have a deeply undervalued microcap protected by a proprietary technological moat, generating real margin expansion, and holding the keys to a multi-billion-dollar federal pipeline.
But the downside is extreme, imminent liquidity risk. It's viewed as a highly volatile 6 to 12-month hold.
And everything hinges entirely on the upcoming Q2 earnings report in August. That's going to be the ultimate stress test.
You have to prove that the 56% surge in April wasn't just a seasonal fluke, right? Confirm the gross margins are holding, and ideally announce a concrete update on the Neutron X pipeline before the cash reserves evaporate.
If the underlying business metrics hold, the turnaround narrative solidifies. If growth stalls while the cash burns, the risk models take over completely.
You know, unpacking all of this leaves me with a lingering thought. We spend so much time discussing the macro transition to a greener, AI-driven energy grid. We demand seamless EV charging and intelligent microgrids.
We want the future right now.
Exactly. But looking at the reality of NextNRG's balance sheet, does the sheer capital cost of building this future require these infrastructure pioneers to live on the absolute brink of financial ruin? Is extreme financial risk just a mandatory feature for the companies brave enough to actually build it?
It's a great point. It really forces you to question whether innovation of this scale can truly survive in the public markets without massive, continuous government subsidy. The technology is clearly ready, but the financial gravity of scaling it is entirely unforgiving.
It is a phenomenal question to mull over as we watch this turnaround unfold. And if you want extra help reading trading charts, you can check out VIP indicators through the link below. The campaign is Grow $100 to $10K. With VIP indicators, and their tools include TradingView indicators, market alerts, and trading education with up to a 93% win rate. But trading always carries risk, and no profits are guaranteed. Use the tools for education and analysis, manage your risk carefully, and always do your own research before making any trade. This is an affiliate link, and I may earn a commission at no extra cost to you.
And if this episode helped you, please subscribe, like, and comment underneath. We'll see you in the next Smart Wealth with Joshua episode.